Good morning, folks, and welcome to another episode with Bob Iaccino. This time, we're going to go ahead and talk about how to identify and trade head and shoulders patterns. Bob, how's it going?
Good. How are you, bud?
I'm doing great. I'm glad you didn't have to wear the headphones where you looked like you were from outer space to tell us about head and shoulders. I'm glad to have you on the show. Let me go ahead and put out the disclaimer real quick because we are going to talk
Forget
about
that
a
this
couple of
week.
different things. What's up?
Don't forget that this week.
I won't. I won't. Thankfully, no one emailed me about it, so we're good. And folks, as always, please let us know in the chat if you have any questions. But last week we talked about double bottoms. Last week we talked about trend lines. Now we're going to go ahead and talk about head and shoulders here. Bob, let's go ahead and start with the easy one. Why should people care about head and shoulders? I know double bottoms are one of your favorite ones, but why do you like head and shoulders as well?
Head and shoulders, they're another confirmable reversal pattern with the ability to measure your target. And that's one of the best things about both of those patterns, double bottoms, double tops, head and shoulders tops, or inverse head and shoulders bottoms, is you can measure your target. You know what everyone else is looking at as the price it needs to achieve, at least that knows how to measure these things. Now, I would say that's probably, people who know how to measure these things correctly, is probably 50% of the trading world. Everybody else just goes, wow, it's going lower. I want to get in on this, which is fine. Nothing wrong with that. That just kind of helps it push it to your target. But when you see a double bottom that isn't confirming as a double bottom, there's often the potential that it becomes a head and shoulders.
Mm-hmm. Well, go ahead and share your chart so we can talk about how to identify a head and shoulders, because that's where often I'm like, is the right shoulder a little bit like a scrawny one? Is it got some bone issues? I don't know what's going on. I don't know if it looks like a head and shoulders, but I want to get on a trade because I'm an addict. That's what I want to do. So go ahead and share your chart so we can kind of talk our way through it. But what you got for me here?
A head and shoulders is unfortunately something that I can't go searching for. It more appears when I've got a particular set of circumstances that have developed, and I notice it through looking for other things through my scanned list of stocks. So I'll be looking for other things, and I'll be like, okay, it's the same thing with double bottoms. I can't technically search for them. What we have here on the Dover Corporation, and I don't want to say it's unfortunate because I'm already long this one, but we do have a developing head and shoulders top. So what you're looking for in this particular instance, okay, is you're looking for a shoulder, a head, and then another shoulder. So a rotation that then spikes up higher than the previous high, and then another collapse and a rotation that does not reach the previous high. Your preference is that the right-hand shoulder is higher than the left-hand shoulder. That's a preference, but not a requirement. So what you do when you find something like this is you draw what's called a neckline, okay? You know, in even personal conversations, I've been probably annoying to you and correcting you when you call double bottoms, double tops, entries and exits their neckline. Mm-hmm. A neckline logically goes with a head and shoulders because you have a neckline with your head and shoulder, right? So it's just a simple thing. What you do when you want to find the neckline is you draw from the inside low of the left shoulder to the inside low of the right shoulder. That forms a neckline. Here's the head, here's the neck, okay? Now, as I mentioned, unfortunately, I'm already long this one. We missed our third target by a matter of, what's my third target there? I'm trying to see, but I've got the microphone in the way. 232.93. And the high here was 232.71. So we fell short by about 22 points to get to our third target. But we've already got, this is not our current stop. Our current stop has been moved much higher. I just don't move it on the charts. I always like to know where my original stop was. So what you're looking at here is the correct entry for this is on a close below the neckline. That's all it is. All right. How do I measure a target? Well, you measure a target, and I'm going to use this tool, but it might fight me a little bit here, is you measure the head down directly to the neck, which is going to be right about here, okay? And then you can move that to where it breaks the neckline. That's your target. So in this particular case, if I draw a horizontal line where I've measured it to right here, the target ends up being around 206.60. Now that applies to wherever the neckline is broken. So if the neckline was broken up here, it would go to here. It was broken up here, it would go to here, and so on until it gets above this right shoulder, in which case it's dead. Okay. So another couple of advantages on head and shoulders over most other reversal patterns. On a head and shoulders, we'll just say the top. The inverse head and shoulders would be on the other side, which I can show you a sort of ugly one on another chart. You draw something called the fail-safe trend line. Okay, here is the fail-safe trend line. It goes from the head to the highest point of the right shoulder. Whether it's here or here doesn't matter. And this is a fail-safe number. What does that mean? If it closes above this trend line, before it closes above the high of the right shoulder, you stop yourself out. That's your fail-safe. The good thing about that is if we keep going lower, your stop is automatically following you down to your target. Okay, I'm going to put the target back in place from where this one is, just so that we can watch it happen. Okay, and this again is one of the beauties of this particular pattern. Come on, I knew this thing would fight me. I have this tool set up to go to highs and lows so that I can easily measure things. So it's kind of fighting me a little bit here. All right, so here's about where it was done. The target, oh, I forgot I drew it in here already. Let me make it green so that I know that it's there. So the target, as we said on this particular one, is about 206.60, right? We can get rid of this now. As the market continues to go lower, if it does, I have a natural trailing stop, okay? Just a close above this line, this fail-safe trend line, that's my trailing stop. Never have to adjust it, never have to guess where it is, none of that stuff. My sort of fail-safe stop, the place where I want out, if it gets above, is a trade above the right-hand shoulder, okay? So I'm gonna get rid of my lines here so that they're out of the way, okay? And I'm gonna draw a horizontal line at the approximate entry, which is gonna be right about here, okay? And I'm gonna make that blue and dashed so that it sticks with what I normally do, okay? This is my target. My first stop is going to be any close above this trend line. I can't really draw a line on there, right? Because it could be any of these levels. I want out of this trade because it's going the wrong way is a trade above the right shoulder, not a close above it, but a trade above it. Okay. So I can put a stop in the market just above here. I really don't care where you guys put it. You could put it all the way up here. You could put it down here. I don't care. But if it trades above this shoulder, the probability shift to the pattern being broken and the ultimate target is not likely to get hit. Now, I've had people trade these a dozen different ways, but these are the concrete factors here. It's the fail-safe trend line, what I call the walk-away stop, which is a stop you put in the markets and walk away from your screen. And that's going to be above the right-hand shoulder. Your entry is a close below the neckline, and your target is the distance between the head and the neckline applied to where the neckline was breached. Pretty simple.
Now this is, yeah, it is, but there's no but here, but it does seem like a great R&R trade as well in terms of risk reward, because I think you're risking about, and you tell me if my line's interpretation is incorrect, you're risking approximately $3 to $4, and you're looking for a reward of approximately, call it $18. If I have that correct, would you suggest a target 1, target 2, target 3? Like, what would you suggest here? Because that seems pretty good in theory.
Pretty good, right? Well, these are less reliable than doubles, just so you know. They run more around the 59% of the time, rather where the doubles run closer to the mid to high 60% if they're done right. But yeah, the risk reward is better on these, which is what you want when the win percentage is lower, right? You want better reward to risk so that when you get stopped out, it's a small loss. When you hit a target, it's a big loss to offset that closer to 50-50 reward to risk on it. I do multiple targets on this, but they're dependent on what the chart looks like. So for example, I've already got my trailing stop, right? But for this one to work, this is the 50-day moving average, the green line. That's probably a first target for me, okay? Where the reward to risk is going to be closer to 1-to-1 on that. When you use this as your risk stop, use this as your entry. We can actually measure this if we want to, if I get rid of this. Well, I don't need to get rid of it. So if I go from here, again, this thing's going to fight me. So if I go from here to here, you're looking at around $4. And then if I go from there to here, you're looking at about 670, right? 680. So you're still much better than 1-to-1 on this particular thing. But the 50 could be anywhere in the case of this. If the 50 was right here and we closed below, I probably wouldn't enter it because the 50 is self-fulfilling as support or resistance, right? Yeah. You could see it happen right here, right? You could see it happen right here. You see the 50 as a resistance and support, the 50-day moving average. And that's one of those moving averages, the 20, the 50, the 100, and the 200, which everybody seems to look at. I don't look at the 100 because it's usually too close to the 50. And I don't look at the 20 because we looked at the 21. So we found the 21 tests out better.
Now,
so that's how you measure it out.
Now, what I like about this one also is that it is hitting the trend line as well as the neckline, if that makes sense, right? It's got the trend line from the top left, the third touch, if you will. Now where you have it drawn. Yeah, so that's one. And then the red candle right after is the second one. So that's something else I like here. Now, you were long on this one. Yes. You missed it by a couple of pennies.
Or the third target. So I've already taken some of this off.
Yeah, your third target missed by a few cents. Would you get back in, but short this time? If no, why not?
Well, as I mentioned before, because I position size based on risk, I could have both positions on at the same time. So the example again would be, let's say that I have 100 shares on long, right? And my position based on the head and shoulders reversal tells me I need to short 200 shares, right? So I would short 200 shares. 100 of those based on FIFO would be covering my long. And the other 100 would mean me being short, okay? Now, the problem in this particular case is my target is well below my stop for the particular pattern. So I would never get back in long once this reached, right? So yes, but you look at those as separate trades that are on at the same time, okay? Gotcha. So in theory, if this didn't work, I would get stopped out of the short and be entered back into the long.
Yeah.
Because I would cover 200. I wouldn't cover 100, which would be the remaining position. But you have to think of these as going on at the same time and you just net them out. Does that make sense?
It does. Now, we all know that the longer time frame, the better in terms of, being more reliable, confirmations, all that good stuff. What would you suggest, or what do you use rather, in terms of time frame to find these and enter the trades? Is it the 5, the 10, the 15, the 30, the daily?
I always go daily and weekly. So for example, here, let me look for another one, and I'm not sure I'm going to find it right away, but I'll look for it. You're not seeing my chart change right now, right?
We are. You just went to MAA MasterCard.
Yeah, that's not what I wanted. I'm going to go to this other one so that it's off the screen real quick because I want to find something. But essentially, I look at dailies and weeklies, okay, to find these patterns. Now, I've already got a set of, here it is, perfect. I've already got a set of models that I run, okay? And, well, it doesn't look the same as the other one. Why is that? Oh,
you've got the weekly at the moment.
Yeah, I need to switch this to a daily. So I already run a set of models that runs on about 7,800 stocks, okay? And on any given week, I could get 5 hits. Last week, I got 47 hits on charts I needed to look at. That's enough for me to find doubles and head and shoulders, right? Yeah. But if you're looking for these kinds of things, what you would look for is a stock that fell from a high and is basing. Okay, it's in a range below its high, because then you know it's got the move. This is an example here, or vice versa, a stock that went up and is now basing and no longer going up. It's looking like it's either getting ready to take off up again, or it's going to reverse a little bit lower. So you look for stocks that have already had big moves and they're kind of moving sideways after their move, whether it be down or up. So in this particular case on Monster Beverage, we have an inverse head and shoulders. Okay. We've got a shoulder, we've got a head, and we've got a shoulder. Now, as I mentioned, I like it better when the right shoulder is lower on an inverse or higher on a head and shoulders top. Okay. In this case, it's not. But so you lose a couple of percentage points of probabilities on this particular one. So we can draw the neckline here, okay, inside of the left shoulder to the inside of the right shoulder. All right. And again, here's the stop. It's at the the bottom of the right shoulder. Okay. We've got a fail safe right here. Okay. And notice how tight this one is. It's very steep. Part of that is because this shoulder is higher than this one. If it was lower, this wouldn't be as steep of a trend, just by nature of the trend line being here, right? Or here, because the low would be lower than this. But hence part of the probabilities, again, be not going your way. Now, there's another thing I should note right here. We got to close above here. That's on an up candle. If I ever get a gap and a close above this on a down candle, I won't enter it. You want the momentum going. Now, I'm not long this one, by the way. Actually, I am long this one, but not off of the head and shoulders because I'm long it before the head and shoulders formed. But what you're seeing right now, let's imagine that we got in here because it closed above the neckline. We can measure here to here. Okay. Then we take it to where the trend line was broken. And it happens to match my other trades target, which this happens all the time with technical analysis, which is why I love it so much. You'll be looking at something completely different. You'll be like, wow, those levels match. It also happens to match with this resistance, right? That ended up being support on the way back down, right? These things all come together, which means there's multiple factors forcing in the direction of where you want it to go, right? But if I would have gotten in this one, I would already be out here. See this particular close right here? Because that closed below the fail-safe trend line, right? And now you're seeing it sort of get close and test this
other one,
right shoulder walk-away stop. But at this point, you're out of the trade. So in this particular one, you would have entered here, got stopped out here. It's actually a slight gain of 46 basis points on this.
Because of the trend line breaking stop was higher.
Higher than your entry.
Yeah.
So, and that's the beauty of this particular fail-safe trend line. Because once it breaks that trend line, it's got a high probability of continuing to roll over.
Yeah. Earlier you had talked about how you missed your third target by a few cents. In that scenario, are you just waiting for it to hit the trailing profit target?
Well,
the trailing stop rather.
Let's go back to that one. I removed all the things from it, but this was the miss, right?
Yeah.
I'm just still in this for the balance of the trade. I just don't move. And a lot of people will say, oh, I just missed it. I'll just get out of everything. I don't do that. Simply because, and this is one where you would push back against me, and I probably wouldn't argue with you too hard that once it missed, you might as well get out. But for me, the process is more important to me than having that small piece of the trade not go my way.
Yeah.
I do the same thing I always do. At the first target, I move the stop. Second target, I take about 70%, 50 to 70% off. In this case, I took 50 off, just in full disclosure. Now, the other 50% of the trade, it may break bad on me. I don't know. But it's the process is much more important to me.
The process aspect makes sense, or else people would continue to say, okay, well, I did it there and then it worked out. I'll just do it again. And then it just
exactly right
goes into a domino effect of bad habits. Well,
and it's again a conversation, Z, about what is close enough to say I got closer. Is it 25 cents? Is it $1? Is it $10? Is it different for each stock? Is it just the mood you're in that day? Is it the bill you have to pay that day? I just can't get into that because, again, the process is the most important thing.
Well, Bob, I appreciate this. Of course, we'll be back next week with more educational aspects of it, but we will see you folks in the next session that we have with Felix on how to trade iron condors. And then we'll talk to Richie at 12 o'clock market time on how to have the right mindset when you're going through a losing streak and still be able to grow your account. Bob, appreciate your time, man. Thank you so much. See you folks next time. Bye-bye.